Market internals are the hidden signals behind the price chart. They show what's really happening beneath the surface. If you learn to read them, you can determine direction and volatility before it's reflected in the price chart. In this video, I'll break down the 0DTE internals dashboard and the 5 market internals it consists of: the volatility index, cumulative tick, volume difference, advanced decline line, and relative sector performance. Now, interpreting market internals is more art than science, which is why we've condensed all of this data into a single, easy-to-read market conditions signal. You'll find it in the upper right corner of the dashboard, updating in real time. The signal comes with 5 alerts to quickly summarize market conditions: neutral, neutral to bullish, bullish, neutral to bearish, and bearish. The dashboard is exclusively available on TradingView, but if you don't use TradingView, you can access the signal in the Market Updates channel Discord server, where the market conditions signal is automatically posted every 30 minutes. Now let's break down each of the key market internals that drive these signals. The volatility index, or VIX, measures expected market volatility. When the VIX is higher, it signals greater expected volatility. Conversely, a lower value signals more stable conditions. From an intraday perspective, trend and rate of change matter more. The greater the change, the more impact it has on the S&P 500. Historically, the VIX has a strong inverse correlation with the S&P 500, around -0.8. A declining VIX is generally bullish, while a rising VIX tends to be bearish. On our dashboard, this metric is displayed as a bubble, color-coded with a numerical value, showing the current VIX level and its daily percentage change. Like the VIX, all the bubbles are color-coded. Green indicates a positive or bullish reading, red indicates a negative or bearish reading, and gray indicates a neutral reading. Cumulative tick measures the difference between the number of stocks trading on an uptick versus those trading on a downtick. An uptick is when a stock's most recent trade price is higher than its previous trade price. A downtick is when the most recent trade price is lower than its previous trade price. Tick, like other market internals we'll cover, is based on the New York Stock Exchange, which includes roughly 2,800 stocks. A tick value of 0 is neutral, indicating an equal number of upticks and downticks. Values plus or minus 400 is a neutral zone, signaling low volatility and a lack of conviction. When the tick hits 600, it signals the beginning of an uptrend with stronger conviction as the values rise. 1000 signals an extreme uptrend, indicating strong buying pressure. On the downside, -600 signals the beginning of a downtrend with stronger conviction as the values fall. -1000 signals an extreme downtrend, indicating strong selling pressure. The cumulative tick is the most sensitive and volatile of the market internals, making it most useful for active traders and short-term position management. It's also commonly used as a contrarian signal to spot potential market reversals, essentially fading the extremes. Volume difference measures the imbalance between buy volume and sell volume. This metric is displayed as a numerical ratio, where a 1-to-1 ratio is neutral, indicating buy and sell volumes are equal, signaling low volatility and a lack of conviction. Ratios around 2-to-1 or 3-to-1 indicates firm bullish volume, with higher values reflecting stronger buying pressure. Ratios around 4-to-1 or 5-to-1 signals a bullish extreme, indicating very strong buying pressure. On the downside, ratios around -3-to-1 or -5-to-1 indicates firm bearish volume, with higher negative values reflecting stronger selling pressure. Ratios around -10-to-1 or -15-to-1 signals a bearish extreme, indicating very strong selling pressure. The advanced decline line, also known as breadth, measures the difference between the number of advancing stocks and declining stocks. Breadth essentially tells you how many stocks are participating in the move. An advancing stock is one trading above its previous day's closing price, while a declining stock is trading below its previous day's closing price. On our dashboard, the advanced decline line is displayed both as a bubble and as a chart. The 0 line is neutral, indicating an equal number of advancing and declining stocks. Values above 0 are positive, meaning more stocks are trading above their previous close than below. Values below zero are negative, meaning more stocks are trading below their previous close than above. When the advanced decline line is trending up, it signals improving breadth and a bullish trend. Conversely, when trending down, it signals weakening breadth and a bearish trend. Around plus minus 800 is the neutral zone, signaling lower volatility and a lack of conviction. Around 1200 signals firm bullish breadth, while 1800 signals extreme bullish breadth. On the downside, around negative 1200 signals firm bearish breadth, while negative 1800 signals extreme bearish breadth. In the bottom panel, you'll find the relative sector performance chart. It displays the market cap weighted performance of key sector groups to gauge market sentiment. There are three major sector groups: defensive sectors, which include healthcare, utilities, and consumer staples; cyclical sectors, which include financials, materials, industrials, real estate, and energy; growth sectors, which include technology, consumer discretionary, and communications. The red line represents defensive and cyclical sectors. The green line represents growth sectors, and the gray line represents the S&P 500. When the green line is above the red line, growth sectors are outperforming, which generally reflect risk-on sentiment. When the red line is above the green line, defensives and cyclical sectors are outperforming, which generally reflect caution or risk-off sentiment. Keep in mind, this is relative performance. It's best used alongside your sector watch list. When sector performance is mixed, some advancing, some declining, volatility tends to be lower. When all sectors are advancing, it generally indicates a strong bullish trend. When all sectors are declining, it generally indicates a strong bearish trend. Growth and mega-cap stocks are the most important, as they collectively account for around 50% of the S&P 500. When growth and megs are strong, downside is often limited. When growth and megs are weak, upside may be capped. The megs bubble shows how the top 7 stocks by market cap are performing relative to the S&P 500. The value is the percentage difference between the weighted performance of the top stocks and the overall SPX daily change. For example, a value of 0.4% indicates that mega-cap stocks have outperformed the S&P 500 by 0.4%. Now, as you can see, market internals provide a lot of detailed information, but take time to learn how to interpret. That's why we've condensed it all into one easy-to-read signal. Our market conditions signal gives you a clear, straightforward view of market direction and volatility. Meanwhile, the 0DTE internals dashboard provides the deeper details behind the signal.